Good morning, it's NFP day. Hope you guys and girls have been doing well. I hope you're all ready to rock and roll. Morning, Kay, how you doing, mate?
Hey, morning, Ryan. We made it. We made it. It was looking at the start of the week that it was going to be a very big hurdle to overcome this week, but we made it. We're finally there, you know.
We're there, but we've got more to do. We're not at the end of it quite yet. A little bit more trading to be done yet, hopefully, and more pips to be made. Remember, Friday's pips are beer pips. If you've had a good week, don't go spending them all your pips, losing all that back to the market on a Friday afternoon. So have a good week, switch off your PC and watch the show rather than risk what you've made already. And if you haven't, this is your last chance to maybe grab a trade, see yourself into the weekend, buy yourself and the kids an ice cream. Right, let's get into it. A PBOC official said that RRR cuts, open market operations, MLF, and all structural monetary policy tools need to be used flexibly to maintain reasonably ample liquidity in the banking system. So keeping one hand on the toolbox and all the tools within. Also said that new structural loan tools will be created when necessary, more of their tinkering to keep things propped up. Over in Japan, Chief Cabinet Secretary Matsuno said that they are considering how to deal with the gasoline subsidies from October. This is part of some of the fiscal measures they've got in place to help with costs over there. They are potentially looking to take those subsidies away, which could indeed bring an inflation boost, particularly with oil prices on the rise once again. Although we're not breaking any new ground just yet, it does look still bullish for oil, which could then give a secondary inflation push to Japan as well. Over at the RBA, they had released a statement about their meeting last week. Nothing really change-worthy in that. They said they may need to tighten further depending on the data and risks, and the full rate rise impact on demand, jobs and CPI is not seen yet. Some potentially good news for Australia and the Aussie dollar, because China has scrapped the barley tariffs that have been in place since 2020. A bit more loosening up in relations between China and Australia. However, there are still wine tariffs in play, which Australians are still taking to a case to the WTO over that, but still a little bit more easing, maybe a little bit of a tailwind for the Aussie economy, and indeed maybe the Australian dollar at some point. Not that we've seen much of it in the Aussie moves this morning. Over at the ECB, and Panetta yesterday said monetary policy may operate not just by increasing rates, but also by keeping the prevailing level of policy rates for longer. More ECB action is warranted if the inflation outlook worsens. We'll decide in September whether to pause or not. So sitting on the fence over there. We do have a bit of data, or did have a bit of data out. Where are we? So yesterday's data, we had Challenger layoffs coming in at 23,000, just under 24,000, so a bit lower than the numbers previously. Jobless claims still looking okay, thereabouts, sitting under that 230 mark. Some labour cost data from the US as well, coming in a bit softer. This was something, or another cost measure that Powell told us to look at. The employment cost index was down, although it's still a positive number. This one looking the same on the labour cost front. Anyway, was expected to come in 2.6, came in at 1.6. So a bit of pressure coming out from the wage side and the cost side. Productivity looking better though. That falls into the soft landing mood, coming in at 3.7%. Services PMIs were dropping as well. As you can see, the final number from the S&P Global one unchanged over the flash number of 52 and down on last month. Or that's a composite, sorry. The services one came in just a pip worse than the flash, but again, still down over last month. The big ISM services number as well coming in and a little miss. Again, another confirmation of a bit of softness, 3 pips worse than expected. Within the details, new orders, off as well, employment, small off, business activity overall, a small off as well. I can't even, where's the prices paid number gone? Oh, there we go, down there. So prices ticked up 56.8, so higher than last month. So some potentially inflationary pressures in that. Kay, I wasn't around for the data yesterday. Did you see anything in the ISM we need to?
It was really an algo blip, mate. Yeah, those prices are a bit volatile. There was a possibility, you know, there's a lot of research and or strategies talking about a temporary uptick in prices. We've seen like commodities, oil move up a little bit of late, still in that broad range, but nothing really to take away as any game changer. I would say really we had a bit of risk on off. As we've seen, we've retested that 45, that low just below 4,500 on the S&P, on the back of those data at the opening of New York. But then things really quiet down. So we had this. If I can actually move over already to the Bank of England, we had this blip on the cable. The move in sterling had been done before the Bank of England, really. So we put in a fresh little low around that 126.25 support, and then we gradually moved up. And another surprising Bailey meeting, because that's now the third one or so where he's talking and cable doesn't crap the bed. So and we're back to the levels before the Bank of England, right? So or before the last leg lower. So really, in yesterday's price moves, I don't think there's a lot to read. No, it's really business as usual. We've seen a global setback in risk for the past couple of sessions. We've seen the emerging markets move negatively, and I'll have a look at that later. And that's about it, mate. You didn't really miss that much yesterday afternoon.
No, I'll go over the BOE stuff shortly.
Yeah, okay.
Just a quick look back at, I'm just looking at the ISM yesterday. One number I wanted to keep an eye on, I'll just put it down here for you guys, is just the inventory numbers here, because that's something that can show, it's a bit of a front runner for if you're going to see economic activity dropping, is if inventories get drawn down, because that means people, rather than order new stuff to keep their inventory stock, they'll actually eat into their inventories. As I say, that can be a bit of a kicker because it stalls activity down the line, down the chain, if you like. So it's just one thing I'm going to keep an eye on in all these sort of PMI numbers and other inventory data. Although inventory sentiment still looking okay on that stuff. They don't do a customer's inventory like they do in the ISM, which was in the manufacturing ISM, which was a negative number. But that's just something I pick up in this sort of data. But yeah, over to the Bank of England.
Ryan,
yeah,
that inventories number is a bit of a double-edged sword. You can read it both ways, actually. If inventories go down, it could mean that the consumer is buying. So I don't know. It's a bit of a, but I understand what you're saying, but it can be a bit of a double-edged sword, in my opinion.
Yeah, and that's why I look at the broad range of inventory data. Obviously, you get the business inventory and wholesale inventories, wholesale sales. That's where you can pick up that indication of how inventories are moving. The US number, business inventories, has business sales. So if you're getting a negative sales number and an inventory drawdown, then you can say there's a bit of an activity problem. If sales are up while inventories are coming down, then you can say that's a bit more positive. It's the old working out what data means any which way, and there's several ways to look at it, as you say, mate. So yeah, over on to the Bank of England, and they went to 25 as expected, although the votes were 6-3 to raise rates by 25 pips. The other, well, out of the three, one wanted unchanged, and that was Dingra, the usual bod, and then Haskell and Mann wanted a 50 pip hike. So the vote number mildly on the hawkish side in terms of there's still people there who want a big hike to that. In the statement, they were saying about Mann and Haskell that they wanted a 50 pip to reduce the risk of more costly tightening later. Dingra on her hold said she sees a risk of over tightening. In the statement itself, the BOE said current monetary policy stance is restrictive, borrowing a line from our mate Powell across the water. Also said if there were to be evidence of more persistent pressures, then further tightening would be required. So as expected, not shutting the door on a further hike. That was a forecast meeting, and so their one-year forecasts showed inflation at 2.82% versus 3.38% in the May report. The report also showed inflation falling to 4.93 in Q4 2023 versus 5.12 in the May forecast. 2 years' time inflation was actually up to 1.65% from 1.09%. 3-year inflation 1.46 versus 1.16. They sound like funny numbers, but they are based on Bank of England models and what the market is suggesting for inflation rates. So take your pick over who's going to be right on that one. So good old Bailey then had his press conference, said we expect inflation to take a further step down in July to around 7%. I think he may well be right on that. I don't know about the number, but he may be right on that. That's been my base case for a while. We expect inflation to fall to around 5% in October. So I will not judge what the path of BOE rates will be. There's more than one path for rates that may deliver inflation back to our target. I don't think there was a case for a 50-point rise today. It's not the time to declare it's all over, and we are sticking where we are on rates. Deputy Governor Broadbent said, I do not think it is possible to be precise about the neutral level of rates. I'm going to tell you now, it's likely to be higher than everyone else. Ramsden, BOE's Ramsden, also sitting there, said, personally, I see a case for a slightly increase in the pace of QT. The MPC has not made a decision on the QT pace, and that will be in September. So a bit of a can kick. Could be that if we get a pause meeting or an end of the rate cycle in September, that might be matched with increase in QT, which will be a bit more in the tightening measures column. So that will, any negativity that might come from pausing rate hikes will still be a bit hawkish if they raise QT, but it's a small move in the grand scheme of things. Right, so after all that, immediately after that, traders saw a 68% chance of a 25 pip hike at the September meeting. I think that's down to about 62% this morning. And as usual, all the banks who were getting carried away with their rate forecasts over the last few months have all been drawing them down again. So BNP, UBS and Barclays have now cut their terminal rate forecast to 5.5% from 5.75%. Some of these clowns were running above 6% a few months ago. NatWest also cut its peak rate to 5.5 from 6% after the Bank of England decision. I don't know if I should be worried or not. They're all in line with where I thought rates were going to go previously. That's always a worry when these guys align with you, but they change like the weather, as we well know. So again, Kate, coming back to the Bank of England, what do you think? One more and done?
Yeah, definitely. I see no reason for them to continue to go all guns blazing, or to continue to go all guns blazing unless they want to be the major country with the highest yields above the well above the Fed. I don't know, but no, I think it's clear, you know. About the QT, I think it was always the plan to make a decision in September, and we also have to know, and I think I talked about that yesterday as well, that QT in the UK has never been the same. QE, sorry, the injections have never been of the same magnitude as they were in the US, for instance, and even in Europe. So it's probably going to be a bit slower and a bit easier, perhaps, to screw back on those if inflation comes down rapidly enough and the economic data don't completely fall out of bed. It's probably going to be easier for the Bank of England to get rid of their QE, sorry. Yeah, and then, as I said, in the aftermath, at some stage, gilts were trying to come off because of this needing to reprice against less hawkish expectations. But that's about it. If you look at the twos, the fives, a lot of people look at those fives in sterling. But it's relatively, you see, you have the blip there, and that's it. You know, we're back to levels where we were before, copying what's happening in the US, I guess, and there we are. I'm, as I said yesterday, I was looking for an overshoot in sterling before the Bank of England to sell into, and then as we were already, the market was already hammering it before the meeting, I got much more balanced, and I think that's the word now for the sterling, balanced. And now we are going to look what the rest is going to do, the US or so. I like the reaction actually of the market just to come back into the middle, and not because it didn't need to go to extremes. But I do find that this morning everybody is relatively relaxed and sterling is doing okay again. You know, I don't have this bearish feeling on sterling this morning.
No, it's funny that it does look a bit more balanced. I'm a bit wary. Maybe we're waiting for the FOMC, and you've got to be careful today, because you know, after this data, it is going to be the summer. You know, a lot of governments are going to go into recess. We may hit summer trade. Doesn't mean everything's going to fall off a cliff in terms of volatility, but what you could get is, after the last data today, is the market, some people squaring up positions, locking in other positions for the summer. So it may be a little bit funky this afternoon. We may get some of this washing machine moves with the market just adjusting things. But, you know, it's not like the old days where as soon as summer hit, markets would die and you'd get 10 pip ranges every day. We're still in the middle of wars. We've still got a lot going on in geopolitics, lots happening. Markets don't switch off as much. But what you may have to be prepared for is quiet periods in between the events, in between the data, things like that, where you might see the prices moving 10, 20 pips in 3 hours. But just be careful today that you don't see a bit of a washing machine turned on. Sorry, Kate, yeah.
And then we're waiting for next week's CPI data. We're just waiting for the next one, you know, to hit. And then we will see again.
Yeah, exactly. But in regards to the pound, I mean, yeah, there wasn't really an extreme move. I thought if we got any sort of rally, it would get hit. We didn't really get much of a rally, really. We just mooched around, had a little dip down, as Kay mentioned, then we had a little pop back up, and here we are back where we were, where we started. But just on the technical front, just looking at this, you know, we had this bit of confluence of moving averages down here, give or take a few pence. It's held, so that gives you a bit of an idea. But, you know, we are potentially breaking this trend. We're now below and holding below the 50 fib of this leg anyway. We've tested the 38.2 of the bigger move, which again is only, let's go into there, which again is only another part of the bigger move that we saw from September, the rally all the way up. I'm not even bothered drawing a fib here yet, because a 38.2 isn't until 120, 121 or something. But you can see we are testing the shorter term ranges and a bit of a longer term range, which gives you a clue. But we're holding where we need to hold. The 61.8 is the line in the sand for the move since May. The 38.2 is a tester for the move since back in March. So there's no reason to say that the whole trend is over, but there's signals that maybe in the shorter term stuff, the move is over. So that's what you need to keep an eye on now. As I said, we've held this, so need to make a decision. Either we're going through this 126.25, or we're getting back up above this area, 127, 127.5. Then maybe we can start to undo this July move. So it's all just trying to match off the price action against your different levels to see what the market wants to do with this one.
Yeah, I think you're right. You're 126.25 on any NFP shenanigans or whatever we see a retest, and holding it, that's going to be a pretty decent level, right? Yeah,
I definitely think that's one to look at. It's made its mark. It's told you it's already got something down here where buyers want to come in. You know, we're what, 70 pips away. So if you do get another move, 60 pips away, if you do get an NFP number that takes you down there, if we can't break again, if you missed out buying on this one, well, you might get a chance to buy on this one. You don't need to give it a lot of room. You can see 126 underneath is the next level. You know, if you're going to trade there, a stop under 126 somewhere is where you're going to be wrong and where this move is going to continue going. But if you get a secondary hold here, that could be a bit significant. I wouldn't be surprised if we went from there back up towards 128 and see what it does thereafter. Looking at euro dollar as well. And again, guys and girls, if you've got anything you want us to talk about, just throw it up in the chat there, and we can have a look at that too. Gavin, 125.50, bit of a level 2 in cable. Definitely, mate. Good eyes. So 109 handle. We had a lot of tech down there into there. Those moving averages have been doing the job. They've stepped up today to 109.18. They were around 109.12, 11.12 early this week, but they've stepped up a bit. And as you can see, that's our level for now. 109 has been a prior support area. What we have done, we've stepped up off this low now that we made, and we're just moving back above this 109.35.40 area, trying to hold it as support. So that's a decent step up. Buyers up here now, parking up here. Just trying to hold it here. If we manage to hold it, then we probably will get a little bit of a push up, maybe back towards 110. 110 is where we need to get back above to undo the pressure that we've seen off of the highs up in the 112s. If we can't get above there, and we can't hold this 40 area, then we're going back down to these lows, and maybe on the second, third time of asking, that's when we get the break and down we go. We're a bit close to all these levels with the NFP right on our doorstep. So, you know, I'm not going to trust them too much going into the number. What you want to look at is where we finish after the number, and maybe where we finish by the close today. If we finish below this 109.30, even below 109, it's going to look more bearish. If we finish above, maybe up towards 110, maybe it looks a bit more bullish, and maybe we can have a crack at that next week. But for now, you've got to sit on the sidelines, I think, and just wait for the data. Now, all I want to have a quick look at, because I'm getting that breaky feeling for this one up at this 82.50, that if you've been following the show for a while, you'll know I've been banging on about this area up here as part of the range, top real solid level up here. We had one test earlier this week, had a decent enough dip. It's come back very quickly. So as I say, I'm getting a bit twitchy that we might get a break. I'm looking at buy stops in this one to potentially capture that if it does happen. I don't know, I may have a little short against there. We got the OPEC plus JMMC meeting later on today as well. I think that starts just before the NFP, so it could be fun and games around that. I don't know. A level's a level until it's not, and it's a big, strong level. I didn't short the first time we got up there, and that would have got some decent pips. I'm less keen to short it here, but I might see what the price action does. If we get through NFP and this OPEC Plus meeting and we haven't broken it, that might give me a bit of conviction to short. But otherwise, I am looking for a potential break trade on this one. And that's dollar CAD you need to keep an eye on, because we is double bubble from the jobs report. Oh, we need to talk about the jobs report, don't we? I haven't even touched on it yet. So maybe we'll do that.
Just a number, mate.
Just a number. Well, I'll look at it after this one.
Just a number. I mean, all the numbers.
Yeah,
we all did our, well, you didn't, but most of us, we had our guesses in before the ADP.
Yeah, well, I was choosy this time. I was choosy. And I've got my own proprietary model. So I've gone for 287,000 in the number today.
Is that in direct correlation with the gas level in your car? Is that model? Yeah.
That's my utility bill each week. No, no. My proprietary model just does what most people do and just plucks it out thin air. So yeah, but I'm going to be right, and you guys are going to have to bow to my magnificence. I can't even get to say the word. Come 13:31 today. Anyway, dollar CAD quickly, and then we'll look at NFP. Then I'll hand it over to Kay. This one, surprising, going against the oil. It's not on the oil bus, which is always a correlation everyone looks at. What's oil doing in terms of what the loon is doing? So while oil is still bullish, this one's still rising. So we're not really on the bus. What I would say is if we do break that 82.50 and probably clear out the 83 level, that will need to be done in US oil. We're probably likely maybe to see a bit more of an effect on here. This has been moving around quite well, while oil for the last 6 months has stayed in a pretty tight range. So there's no real reason for this to go anywhere new. That's probably a big reason why it's been off the oil correlation for quite a while, because we've had that fairly tight range in oil prices. Usually this moves if we're getting big significant oil price changes. But there's a lot going on in the dollar, a lot going on with central banks that are overriding the correlation as well. Pretty clear, 134 is the next level up here. If we are to move higher, it's still holding above up into the 133s. So that's fairly bullish. It's really going to take, if we, again, where we're going to finish today. If we finish below 133, we're probably back in the box down here. Might be on for a move back down to the 131s perhaps. But if we finish up towards here, I might not be surprised if we get a break above 134. And then maybe we're going to be heading up towards 135. So again, I'm going to be looking at where we are on a closing basis for this one. Right, quick look at NFPs to see what's coming. And because we want to know, everyone wants to know how to trade them as well, I assume. So the general consensus is for 200,000 for the NFP. Obviously, the headline number is always important in the first instance, but you have to know how to read all the other data. The other big data is going to be the wage numbers, average hourly earnings. If they go higher, they're expected to drop 2 pips to 4.2. If they go higher, if they go above the previous number, 4.4, that's going to be a hawkish signal for the Fed, at least for the higher for longer rhetoric from those guys. Only if we probably get wages, getting above 5% and moving higher and a bit of a trend, might that get the Fed talking about more hikes, or at least the market talking about more hikes to come, because they'll be worried about a wage price spiral embedding in there. And there's some, I don't know if you've seen, Kay, there's been some big talk over there. Is it Detroit car manufacturers looking for a 40% pay hike? I don't know if you've seen that one. I saw that crossing.
No, I missed it. Sorry.
Yeah, I haven't seen the details. It sounds a bit far-fetched, but
where is that?
Detroit, the big car manufacturing area.
Well, yeah. No, I didn't see that. Sorry, mate. No.
Yeah, no worries. I just point it out. So there are things that are going on in the US that might suggest wages potentially going up. So anyway, yeah, so look at the headline, look at the wages numbers, then look at unemployment. Unemployment rate expected to come in unchanged at 3.6%. That may be the case. If you get a change in the unemployment rate, you have to match it off against the participation rate to see what that's done. If the participation rate goes up, it means more people are coming into the jobs market to look for work. So they are becoming officially unemployed, if you like. They go on the records as being unemployed. So that can push up the unemployment rate. If you want a perfect storm, you want to see the participation rate going up and the unemployment rate coming down. That's a big positive. That means that more people are coming in, but more people are finding work. So that's how, again, how you read between two different sets of numbers as to whether one is good or one is bad. So that's how to trade that number. I don't, unless we get another big out there number, I don't think we might be moving a lot on this one. I don't think there's going to be too much volatility because the jobs market is solid. The market knows the jobs market is solid. We're all waiting for the time it turns. Could it be this month? Who knows? But that is going to bring the volatility more than a decent upside number. So as mentioned, if you're going to get a big bullish number, you're going to look at your charts, look at your levels you like to trade, like maybe 126 and a quarter in cable, 126 even, 109, 109.18 in euro dollar, and you look at your levels the other side. If it's a bad number, always trading this is about what the market can do with it. Can it break your levels or can it not? If it can't break your levels, well, there's your potential trade. But also it's double bubble. So for loony traders, we've got the CAD jobs report as well. Look for the employment change. Also look at the full-time, part-time revolving door here, because that can make this, let's say we get a positive number, another 50K coming into employment. But if that's all going into part-time and we've seen losses in full-time employment, that makes it a little less strong report. You want to see a good trend in full-time employment, which is what we've been seeing of late. So the jobs market is looking solid over there. Also, you can do the same sums with the participation rate in unemployment rate. So if you're trading the loonie, you've got to be careful because you can either get two forces going the same way, i.e. if dollar CAD's going up, you might get that because it's a good US jobs report and a bad Canadian report. So they can offset or they can aid each other's moves, if you get my drift on that. You're looking in anything particular from these numbers, Kay?
Yeah, well, if you look at the global data, okay, inflation has been coming down, and then particularly in Canada, I've seen nothing in the Canadian data, because if you look at it and rightfully point to that, if you look at the balance of part-time, full-time employment change last time around as well, it's all good. So it's a little surprising, actually, perhaps, that the Canadian dollar is trading on the weak side, right? With oils up, etc. Yeah, before that we had one negative on the Canadian, but then it's been relatively stable and pretty good over in Canada. There was a lot of scares around the Canadian housing market. I haven't seen too much of a disaster there either, although that's been slowing down. But if you look at the macro view or the global view in Canada, it's not looking that bad, right? So in that respect, we may be a little surprised, and perhaps the Canadian dollar is just waiting for a good confirmation to turn around a little bit in case oil would fly or so. I'm a little, doubtful that the Canadian dollar has much more to lose, but the market is the market, and who are we to stand in front of it, right?
Yeah, I mean, look at that too. Well, if you go back a year, we've had two negative jobs reports in the past year. Going back into 2022, it's a bit more choppy, but as you can see, the numbers have been pretty solid out of Canada. They can be a bit more volatile, so you may be a negative number, but if you look at the trend overall, you all those greens rather than reds. Yeah, go on, mate. Sorry.
No problem at all. No problem, mate. I was relatively done. If you want, I can have a look at what the market is actually pricing for today,
Yeah,
because
go ahead, mate.
the options market really is not overly ecstatic on what to expect on today's numbers. Really, yeah, I can share the screen if you want.
Yeah, let me pass you the baton. There you go.
Right, here we go. So I was showing that in the room as well. Well, I got pointed at it. So if you look at the overnight vol, which is really pricing in the jobs report, yes, the volatility is a bit higher, but it's overnight, so that's not going to change. If you see such differences in the longer term, that's going to have a big impact on pips, you know, pricing. But if you look at, for instance, the at the money overnights, 50, 54, 55 pips cover the euro dollar. If you look at even, and then we look at the dollar CAD, where we are, 133. Yeah, if you look the same 55, okay, and even taking into account less liquidity in the Canadian dollar, 60 pips cover the whole report as well, and we could have a double whammy on the US and the Canadian report. Even in the dollar yen, which has been extremely volatile of late, less than 100 points cover the dollar yen between the puts and the calls at the same strikes for the overnight. So the option market is really not telling us that they expect a big move from these reports, which is a bit funny because we did have quite solid moves of late. So is this the market being a bit blasé? Is this the market being tired to have been chopped around for weeks? Or is it actually the summer expectations kicking in, or just telling us that these reports are still not as big an event as inflation may be? So yeah, for today, it's a bit, and I was a tad surprised, though, I must say, that these option vols were so low. If you look at the cable, 70 pips cover your cable between up and down. So, and if you look at it, post BOE, we already did those. So the options market is really not, or doesn't price in any surprise reports. Let's put it that way. So it's relatively quiet on that side. And I'm not saying that options market are always right, but there's a lot of stuff going on in the options market, so we cannot completely discount what those people are expecting, because there's a lot of money flowing around. That's all. So
can you just give I don't know, well, how quick you can keep it can be in options. Just what does it mean? So what does that price mean? That price means if you buy the strike, you know, you have to make 30 pips, 35 pips before you get into profit. So the price has to move, you know, what, 40 pips before you get your money back?
Yeah, so I'm going to just look at it from a point from our point of view, retailers. We are not options market prices also. But yeah, if you buy a call now at 127.05, your break even is around 127.39. If you buy a put, your break even is going to be around 126.70. If you buy both sides, you need a 70 pip move to get out of it. But if you buy both sides and you just want to play direction, you're going to need 127.75 or 126.35 to break even. But those are moves that can easily be done on an NFP, right?
Yeah.
So that is what I mean by it's not pricing in too much volatility. If you look at the dollar yen, for instance, the at the money is now 9.52%. That's an average, right, between puts and calls that they put. They are not going into those details. Pre Bank of Japan, that was up at 40%, just to give you an idea. And the at the money were costing more than a big figure each side. That's just to give people an idea about expectations on an event. Okay, I mean, it's still a move, but you're looking at 50 pips in the dollar yen is 0.3, it's less than 0.4%, right? So it's the options market is really not expecting big waves on the back of these reports. And if you look at the dollar CAD, for instance, and now that I'm looking at it, I might actually be tempted to do one on the other side, because that's really not a lot. That's really not a lot. Yeah. Okay. I'm not going to give away any secrets here, but for instance, if you say like, okay, Canada is a little underpriced compared to oil, compared to what the data have been in Canada, and compared to the move we have done, just for instance, if you would buy a put, okay, we are retailers, you're probably going to be charged more. That's probably going to cost you 32, 33 pips or so. You buy this put 133. That's going to put your break even just above 133.30. Let's put it that way. That's really not no theft, you know, compared to what the possible move could be on the jobs data. Now, what you could do is like, if you see a little move down, let's say to 133.30, is buy half of your notional, and then if it then starts to go up again, you fool around with your notional, right? That's what they call the changing gamma and stuff. But to keep it simple, you can just fool around them with half your notional. If it continues,
so just to explain to people, you've bought the put for 32 pips. The price has moved down. You then buy spot at 133.30. So you're locking in your profit in effect. And then you can sell that up if it goes back up again and your put becomes worthless. Well, you're long the spot now. So you've covered both sides, if you like. That's sort of what Kay's alluding to now.
Yeah, you reduce your risk. You get some. You get close to your premium level, and then you're actually long or short. Because if you buy half the amount that you put in it, let's say, for instance, if you buy a put for let's say if you buy a put for $100,000 and it goes down to 133.30, you buy $50,000 back, and then you're actually long or short because you bought the $100,000, so you're still $50,000 short. But if it goes up and your put becomes worthless, you're going to be actually long $50,000, and then it goes up again. You can sell those out, pay your premium back, and if it goes further, make a little bit of money.
Yeah,
I might go a little fast, perhaps for newbies, but anyway, that's that's
some good insight. Give people a bit of idea.
That's a bit how I usually play those options when I do. But I usually do a bit longer term, and then I fool around with bits and pieces of my notional. And if you trade that around, it's pretty cool to pay the premium back and to add a bit of money. But for the overnight, you're going to have to be right quick and actually act a little bit sooner as well. Even if the number is really good, you should actually cover just a piece of it, you know, just to make sure. So that for the options, and saying that the options market is not really too worried about what is coming up later today. Now, Ichimoku, and a lot of people know what the Ichimoku clouds are, and they look at the cloud and they know what it means. Just going to run quickly through it. The Japanese people really look at those things, okay, for closes, for trends, if baseline and conversion line cross, for instance, they look at it. And what we have to know, and you remember when on BOJ day, I told you we have done exactly top and bottom of the cloud over the Bank of Japan, and that's no coincidence, right? If you have a little bit of a Japanese knowledge and knowing what those people think over there, that is not a coincidence. All right. So the next day we moved over it, and we have been trading along it, but we never closed inside. So for the close today, I reckon it's going to be important enough. So the top of the cloud is 142.45. That's extremely close to the market. If we get a close below, well, there's two options really. Two possibilities. Either you're going to go sideways, but there is a chance you're at least going to test some of those lines attached to the cloud. And you have two lines here, which is the baseline, this one in red, and the conversion line, which is in blue. And I just left it there just for the add-on interest, and they are all lying around 141.15 down to 140.95. And recall on the charts that we were showing before the Bank of Japan, where we had these levels at around the 141. Well, look at this. The baseline is still hanging around there. So that to me is going to be, if the NFP report is really bad, that is going to be your major level here on the close. So first point is, are we inside again or above the cloud? If we are above the cloud, then we're probably going to go back test those mid 143s for a starter. But if you're inside, then you start to look at this one. Okay, and then for the longer term, but I don't think that this report can be that bad for going that low. You're going to be looking at the underside, which is around 139, and then we're starting to talk about those big prior lows again. But if it goes back or below 139, this is going to look very bad. If you look at the shorter end, and just people, okay, I'm not going to say you can't, but I'm just going to tell you what I learned in Japan from my Ichimoku sensei. They never ever look at anything below the 4 hours, okay? Anything below is noise for them, right? So there's not going to be one investor in Japan. Retail traders, don't discuss, but there's not one investor in Japan who is looking at stuff on the clouds below the 4 hours, all right? This is really, and some of them are really looking only at daily, weekly, and stuff like that. But we have to know, we have to note here the conversion line. You see this when it broke above the baseline, dollar yen was moving up and up and up. Now we've corrected. Okay, the gap was a bit too big, but now those two are coming very close together again. And look where it stopped the dollar yen yesterday, right on the conversion line, and where it stopped on the underside in the past few hours is on the baseline. So this thing is converging now, and that may create a relatively sharp move if they would cross over. The thing is, if they don't cross, and if they start if they continue to run along each other, for instance, that is usually telling you that the move is going to slow down, but the direction is not changing. Okay, so this is the volatility of the past few days. That means that the cloud is very thin, but it's starting to widen open. So that could tell us that if those two run together, that the move is really going to slow down. So that a little bit about Ichimoku and what I learned, at least over during my years in Japan. If you have any questions, I'm not a specialist yet, because it takes a long while to get it all under control, but I know a couple of things about it. Do I have time to look at the emerging quickly, Ryan?
Go on in.
Just a quickie. You guys have seen this 1740 in dollar mix, okay? Test above, rejected, but if you look at the move, we're still not out of the woods. I would say on an NFP, for this to cap and start to reverse, actually NFP should not be too bad. Even if well, the dollar could be could still be rising, but MEX could do usually for the risk for the risk side of things, could do with a slightly good US report. And then been talking about this Euromex. Okay, we're in testing times. 1902, 1910, 11 over here, but especially the 19 here, close above or below in the Euromex is going to be relatively important today, and we're bang on it again. We're trading on the level into the FOMC. look at this one for risk, I'd say. Okay, if it's bad for risk, then I would say there could be more getting out of carry trades. If it's relatively good for risk, this may just cap here and start to slowly move down again. And then the last one is your dollar China, still below this trend line, but we're holding still above this 715, 714, 716 support zone. We're still holding above. Okay, so that is your range for dollar China. I think the Chinese yuan is still not out of the woods, but we are going to need to break those levels to keep on going. PBOC was again saying that they will use all their tools, I know flexibly, but this afternoon the dollar may tell us whether we're in for a retest here or a break above. Rand very weak still. I wouldn't counter trade any of this. Keep an eye on what's going to happen if we get up to 19. And I suppose that anywhere close to 18 and a quarter, 18.35, we are already going to see buyers now. And that's it for me, Ryan.
Thank you very much, mate. And so ends another week for us lot here in the Flow Show. As always, thank you very much for coming to the Flow Show, giving us your presence. I hope we've set you up well enough for the day ahead for the NFP and whatnot. So just remember, be careful with your trading. You know, sometimes it pays just to let the market do its thing and then pick up the pieces after if your levels have held. I'll just quickly pop the link in for the NFP competition again in the chat there. Last moments to enter your numbers on that one. Win a free month on the ForexAnalytix platform. Thank you very much, Kay, for all your valued input as usual this week. And I'll thank Stelios. Well, I might thank Stelios, the holidaying, surfboarding, lunch eating bloke that he is.
Yeah, we don't even know what he is having for lunch today. I mean,
no. Well, he won't be going out and getting it himself. We know that for a fact. Anyway, fish again. Yeah, probably. Anyway, thank you very much. Have a great week, everyone. Trade well. See you all next week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.